You have heard the reassuring story. Your retirement is safe because it is diversified. You did everything right. You saved for 40 years, paid off the house, bought the bonds they told you to buy at 60, took the pension, signed the annuity, and every advisor on television tells you the same thing: stay the course. The market always comes back. But what if the risk in your retirement was never the market at all? Every single thing you are retired on is a promise made to you by an institution. A pension is a promise, an annuity is a promise, a bond fund is a stack of promises, a bank deposit is a promise, Medicare Advantage is a promise, even the equity in your house is a promise that somebody younger will be able to borrow enough to buy it from you, and a promise is only worth the balance sheet standing behind it. Trillions of dollars of that balance sheet were built at near zero interest rates in 2020 and 2021, and it has to be rebuilt in 2026 and 2027 at rates that no longer exist. That is not a narrative, that is a calendar. Here is my thesis, and I'm going to lay it out plainly, because on this channel, we do not do panic and we do not do cheerleading. We follow the logic of power. We follow the incentives, and when you strip away the emotion and the headlines, the picture always becomes clear. Today, I'm going to show you exactly three things. First, the danger to your retirement is not a decline in asset prices. It is the repricing of the institutions that owe you money, and that repricing was scheduled 5 years ago. Second, 14 of the assets in an ordinary American retirement sit directly on top of that repricing, and they are not the 14 the financial press is discussing, and I'm going to name everyone. Third, every backstop you are counting on, the FDIC, the pension guarantee, your state guarantee association, Social Security itself, is real, is capped, and protects the average holder. It does not protect the marginal one. And after 70, almost everybody is marginal somewhere on their own balance sheet. Keep those three claims in your head, because everything I'm about to show you is evidence for them.
Let me start with the facts, because you need the ground beneath your feet before I take you into the analysis. Fact 1. According to S&P Global data, total corporate debt maturities in the United States jumped from roughly $2 trillion in 2024 to roughly $3 trillion in 2026. That is a 50% increase in the debt that must be refinanced in a single year at rates that are multiples of what it was issued at. And those bonds are not somebody else's problem. They are what sits inside your bond fund and inside your annuity company's portfolio. Fact 2. The FDIC's own quarterly banking profile shows American banks carrying hundreds of billions of dollars in unrealized losses on their securities portfolios. That is not a loss on a risky loan to a struggling business. That is a loss on the safest thing a bank owns. Fact 3. Federal deposit insurance covers $250,000 per depositor, per insured bank, and that number has not moved since 2008. At Silicon Valley Bank in March of 2023, roughly 94% of deposits sat above that line. Those depositors were made whole by a discretionary invocation of the systemic risk exception. Hold on to that word, discretionary. Fact 4. Moody's puts the national office vacancy rate near a 40-year high at around 20%. Those buildings are collateral on loans held disproportionately by banks well below the size of the money center institutions, which is to say the banks where retirees keep their certificates of deposit. Fact 5. More than half of all Medicare beneficiaries are now enrolled in Medicare Advantage, a privately administered plan whose benefits are reset every year by an insurance company's own margin arithmetic and not by statute. Fact 6. The Social Security trustees project the Old Age Trust Fund reserve is depleted in the early 2030s, after which payroll taxes fund roughly 3/4 of scheduled benefits. That is not the government going broke. That is a legislated reduction with a published date on it. I am not going to interpret any of that yet. Those are the coordinates. They are settled, they are dated, and they are public. Now I need to give you a name for the mechanism, because a thing you can name is a thing you can track. I call it the promise gap. It is the distance between what a promise is worth on paper and what the balance sheet behind it can actually pay on the day it has to be honored. Here is how it works in a household. Imagine you retired in 2021 with $600,000, and you did exactly what you were told to do. Conservative bond fund yielding 2%. That is $12,000 a year. Today, the same fund yields 5%, which is $30,000. So higher rates helped you, correct? No. Because for the yield to go from 2% to 5%, the bonds you already owned had to fall in price. Put real numbers on it because the arithmetic is the whole argument. A bond fund with a 6-year duration loses roughly 6% of its value for every point that rates rise. Rates rose about 4 points. Your $600,000 became something closer to $460,000 before you withdrew a single dollar. You did not get a raise. You got a larger coupon printed on a permanently smaller number, and if you were drawing 4% a year while that happened, you were selling the shrunken shares to eat. Nothing about you changed. Your spending did not change. The only thing that changed is the price of money. That is the promise gap, and it does not care about your intentions. Now scale it. An insurance company that sold you an annuity guaranteeing 5% for life did not put your money in a vault. It bought a portfolio of corporate bonds and increasingly since 2021, private credit, which is lending to companies that are not publicly traded and therefore not publicly priced. When those companies have to refinance in 2026 and 2027 at multiples of what they borrowed at, some of them will not. The guarantee written to you does not change. The assets standing behind it do. That gap is not an opinion about markets. It is subtraction. A pension fund promising you a $3,000 monthly check values what it owes you using an assumed rate of return. When it assumes 7% and earns 4%, the shortfall does not appear as a loss on any statement you are ever shown. It appears years later as a funding notice in your mailbox. And a regional bank with $40 billion in commercial real estate loans does not care about the stock market.
It cares about the day those loans roll over, and the collateral behind them has to be revalued. A building appraised at $100 million in 2021, financed at 60% loan to value, carries a $60 million loan. If that building is worth $60 million today, the loan is now 100% of the value of the asset. To refinance it at the same 60% standard, the borrower has to write a check for $24 million in fresh equity that does not exist. The loan does not fail because the tenant left. It fails because the appraiser showed up, and your certificate of deposit is a liability of that bank. Here is what makes the promise gap different from every risk you have been taught to manage. You cannot diversify away from it, because it is not in the assets, it is in the counterparties. You can own 8 different things and have all 8 be promises from institutions that reprice on the same calendar. If you want to run that test on your own accounts before we go further, the first section of the Retirement Reset Blueprint walks you through building a counterparty map in about 20 minutes. Link is in the description. Now let me show you where the mechanism lands. The 14 assets I am about to name are not chosen by headlines. They are chosen by the structure of the balance sheet standing behind them. And I want you to hear the logic so you can test it yourself. One question decides membership on this list. Does this asset depend on somebody else's balance sheet refinancing at a higher rate? Or does its value depend on a buyer who has to borrow at today's rates? If the answer to either is yes, it is on the list. If the answer to both is yes, it is near the top. Group 1, promises written on somebody else's balance sheet. Number 1, single employer corporate pensions. The check is only as good as the company writing it, and here is the part most retirees never registered. A great many sponsors have de-risked, which is the industry's word for selling your pension obligation to an insurance company. The day that happened, you stopped being a pensioner protected by the federal guarantee and became a creditor of an insurer. Most people were told by letter, and most people filed the letter. Number 2, multi-employer union pension plans. The trades, transport, retail food. Many were stabilized in 2021 with federal money sized against assumptions about what the plans would earn on it. The rescue was priced in one interest rate environment and has to survive in a different one. Number 3, fixed and indexed annuities. The single most recommended product for Americans over 65 and the one whose asset side changed the most after 2020. A large and growing share of American annuity liabilities now sits with insurers owned by or affiliated with private equity firms whose portfolios lean toward private credit and structured assets that are estimated rather than observed. The guarantee is on the front page of the brochure. The portfolio is in the annual statement. Number 4, whole life cash value and universal life. Same portfolio problem and a second one on top of it. Universal life policies sold in the 1980s and 1990s were illustrated at interest rates that never arrived, and that shortfall eventually reaches an 80-year-old as a premium demand. Group 2, the bank layer, which is the transmission wire. Number 5, deposits above the insured limit, $250,000 per bank, per ownership category. And the most common way an ordinary retiree ends up over that line is not wealth. It is timing. It is the couple who sold the house and parked the proceeds in one bank for 6 months. Number 6, long certificate of deposit ladders at regional and community banks. A bank pays up for deposits when it needs deposits. The yield you are being offered is information about the institution offering it. Number 7, bank dividend stocks and bank preferred shares, the retiree income staple for 2 generations. In a bank under stress, the common dividend is the first thing cut and the preferred is the first thing suspended, and both happen before any headline is written. Group 3, bonds and the things that were sold to you as bonds. Number 8, corporate and multi-sector bond funds, including the bond portion of your target date fund, which is the part you were told was the safe half. It holds the same $3 trillion of maturities we opened with. Number 9, high-yield funds, business development companies, and anything with the word income in the name. The yield is the risk premium, and the risk is refinancing. They pay you more precisely because the borrower underneath is the one who has to roll over first. Number 10, non-traded REITs and interval funds sold to retail retirees. This one almost never makes the list, and it belongs near the top. They are not traded, so the values are estimated rather than observed, and redemptions are capped, typically around 5% a quarter. That cap is not fine print. That cap is the product. It exists to prevent you from leaving in the exact month you would most want to. Group 4, the house. Number 11, home equity itself. Your house does not have a price. It has a price at which somebody younger can borrow. When that buyer's payment on the identical house doubles, your equity has been repriced by their mortgage rate, not by anything that happened in your neighborhood. Number 12, the reverse mortgage or the home equity line held as a plan. A line of credit is a promise from a lender, and lenders reduce and freeze lines when collateral values fall. The reserve you are counting on becomes unavailable at the precise moment you would reach for it. Group 5, care, and these are the 2 that almost nobody puts on a list. Number 13, Medicare Advantage supplemental benefits, the dental, the vision, the hearing aids, the gym membership, the reduced Part B premium. None of that is statutory. All of it is set annually against an insurance company's margin. When the margin compresses, the extras are trimmed or the plan exits your county. Number 14, the continuing care community entrance fee. You hand over a 6-figure refundable entrance fee and become an unsecured creditor of a nonprofit financed with municipal bonds issued against occupancy projections. If occupancy falls and those bonds cannot be serviced, your refund is not a deposit. It is a claim in a bankruptcy filed by a 90-year-old. 14 assets, 1 mechanism. Every one of them either depends on somebody else's balance sheet refinancing at a higher rate or on a buyer who has to borrow at today's rates. That is the criterion. And notice the shape of the list. It is not an asset class, it is a layer. It cuts across banking, insurance, housing, healthcare, and pensions, which is exactly what you would expect from a mechanism that operates on counterparties rather than on markets. If 2 or 3 of those 14 are in your accounts, the blueprint has a checklist for each one. Keep watching though, because the timing is the part most people get wrong. Now let me take you deeper because this is where it gets genuinely alarming. 3 calendars converge in the same window set independently of one another. The first is the maturity wall, $3 trillion of corporate debt repricing across 2026 and 2027. The second is demographic. The United States is passing through the largest wave of 65th birthdays in its history, more than 4 million Americans a year through 2027. The largest cohort ever to stop earning and start drawing arrives at the exact moment the institutions they are drawing from have to refinance. And the third is the labor market, which has already begun to crack. Employers cut jobs in the summer of 2026, and the revisions added tens of thousands more losses to the months before that. Sit with the revisions for a moment because the revisions are the more important number. A revision means the economy was already weaker than reported at the time. Everybody was calling it strong. The data did not change. Our knowledge of it did. The wall and the cracks are arriving together. They are the same event seen from two sides of the same balance sheet. That is the escalation, and it is already underway. So let me connect the dots, because the picture only makes sense when you see the whole thing at once. The bank paying you 5% on a certificate of deposit is not evidence of a strong bank. It is evidence of a bank that needs your money. The office vacancy rate at 20% is not a work-from-home story anymore. It is a collateral story because those buildings sit under the loans held by the institution holding your savings. The insurance company guaranteeing your income for life is not underwriting that guarantee with treasury bonds. It is underwriting it with credit that somebody has to refinance in the next 24 months. That is not a crash. That is a repricing. And a repricing is worse because a crash is over quickly and a repricing takes years. Before I continue, I want to present the strongest possible argument for the opposing side because I owe you the real debate, not a simplified version. The bull case here is genuinely strong, and I will not pretend otherwise. The Federal Deposit Insurance Corporation has not lost an insured depositor a single penny since 1933. Every state operates a guarantee association that covers annuity holders when an insurer fails, typically to $250,000 of present value. Social Security is not going to zero. It is projected to pay roughly 3/4 of scheduled benefits, with no legislative change at all, and Congress has never once allowed that reduction to land. United States household net worth is at a record of more than $180 trillion, and the largest share of it is held by exactly the generation now retiring. And the Federal Reserve has been cutting rates, which raises bond prices and lowers the cost of every refinancing on this list. The Steelman says the wall is manageable. The maturities are staggered. The guarantees will hold. The Fed will ride to the rescue, and the record household balance sheet will carry the retiree through. And I want to be fair to it. The staggering point is real. These maturities do not all land on one Tuesday. A good business with a patient lender can push a maturity out 2 years and survive to refinance in a friendlier market. That is why this wall has been predicted before and has not produced a crisis. But the Steelman cannot explain one thing. Every backstop I just named is capped. Every cap is per institution, and not one of them has moved with the size of retirement balances. $250,000 unchanged since 2008. State guarantee caps unchanged for decades. The Steelman reads the average. The promise gap kills the marginal, and the marginal holder is always the first one to tell you the truth because the marginal holder has no cushion and no time. Here is the pillar, the piece of evidence that is simply incompatible with the benign reading. At Silicon Valley Bank, 94% of deposits were above the insured limit, and the only reason those depositors were made whole is that a handful of officials, over a single weekend, invoked a systemic risk exception they were not required to invoke. That is not a story about failure. The FDIC did not fail. It performed. The problem is that the benign reading assumes coverage, and what happened was a choice made for a bank full of technology companies in California in 2023 is not a promise made to a retired couple with a community bank in Ohio in 2027. That is the difference between a theory and a mechanism. A theory can be argued with. A mechanism just runs. Now bring in the other countries, because this mechanism has already run before in living memory, and every time it ended the same way. Japan. Everybody remembers what happened to the Japanese stock index after 1990. Almost nobody remembers what happened to Japanese retirees. Between 1997 and 2001, a series of Japanese life insurers failed. Nissan Mutual Life, Toho Mutual, Chiyoda Mutual, Kyoei Life. Policyholders who had bought guaranteed products had their guaranteed rates cut in restructuring after the promise had been made, and after the holder was far too old to rebuild. And for everyone who did not lose a policy, 30 years of near-zero rates meant a saver's income simply never came back. Japan did not have a crash for its retirees. It had a slow subtraction. Detroit. In 2013, the city entered bankruptcy, holding pensions that were widely understood to be constitutionally protected. General retirees came out with a cut to the base pension and the loss of the cost of living adjustment, which over a 20-year retirement is by far the larger of the two. The lesson is not the size of the cut. The lesson is that a legal protection was tested and discovered to be a claim, and a third case closer to home. In the late 1980s, American savings and loan institutions were sitting on commercial real estate lending underwritten at values that stopped being real. Regulators permitted forbearance, the accounting equivalent of looking away, and the delay did not shrink the losses, it grew them. By the time the Resolution Trust Corporation was created in 1989, more than 1,000 institutions had failed, and the cleanup was paid for by taxpayers rather than shareholders. Commercial real estate, held by small banks, valued by hope. The lesson from all three is identical. When a promise meets a repricing, the state can postpone the day, but it cannot cancel the date. It only decides whether the pain arrives as a sharp event or as a slow decade. And if you are 72 years old, understand which of those two is worse for you. A slow decade is longer than the time you have to recover from it. So let me give you 3 predictions, dated and falsifiable. Write these down, come back in 12 months, and tell me if I was right. Prediction 1. Before the end of 2027, a United States life insurer or annuity writer with more than $10 billion in liabilities will be placed under regulatory supervision, or a carrier of scale will restrict withdrawals on an in-force annuity block. Prediction 2. Before June of 2027, at least 2 of the following 3. A regional bank with more than $50 billion in assets resolved by the FDIC or sold in a forced sale over commercial real estate losses. A senior living operator with more than 20 communities filing for bankruptcy, or a non-traded REIT gating redemptions for 2 straight quarters. Prediction 3. By the end of 2027, Medicare Advantage plan exits and benefit reductions will affect more than 1 million enrollees in a single plan year. Those are not vibes. Those are numbers with dates attached. And let me be equally clear about what would prove me wrong. If bank unrealized securities losses shrink materially and high-yield spreads stay below 400 basis points through 2027 and no annuity writer of scale enters supervision, then the mechanism I have described is not operating, and I will say so. If I am wrong, you will have the receipts and I will stand in front of them. And here are the things you can watch yourself without waiting for any headline. First, the FDIC Quarterly Banking Profile, published 4 times a year and free to anybody. Watch 2 lines: unrealized losses on securities and commercial real estate concentration relative to capital. And your own bank is in the FDIC's Bank Find database by name, with its own numbers, and almost nobody watching this has ever looked it up. Second, the financial strength rating on your annuity or life insurance carrier, and more importantly, the outlook attached to it. A downgrade is slow. An outlook moving to negative is early, and it is published, and it is free. Third, the high-yield credit spread, the gap between junk bond yields and treasury yields, published daily by the St. Louis Fed. When that spread blows out, refinancing stops being expensive and becomes impossible. Note the distinction because it is the whole ballgame. Expensive debt shrinks a company, unavailable debt ends it. And fourth, the annual notice of change from your Medicare plan, which arrives every September. Most people put it in a drawer unopened. It is a leading indicator, hand-delivered to your mailbox, of what an insurance company believes about next year. Read it next to last year's letter, and you will know before the news does. And this one is personal, because the aggregate economy is not where you live. You live in one bank, one insurer, one pension, one house, one balance sheet. When the headline says household net worth is at a record, it is describing an average of more than $180 trillion, and most of that is owned by the top 10%. Your household is not the average. Your bank is not the average. And there is one asymmetry almost nobody says out loud. If you are over 65, you carry the same exposure as a 40-year-old and none of the recovery time. A 40-year-old who loses a third of a portfolio earns it back with a paycheck. You do not have a paycheck. That is not fear talking. That is arithmetic. The promise gap does not announce itself in the news. It announces itself in a letter, in a rate change, in a benefit that quietly disappeared. So look at your own balance sheet the way I am asking you to look at the country's. Who owes you money? What is standing behind their promise? And on what date does that promise have to be rewritten? That is not panic. That is preparation. Which is exactly why I built the Retirement Reset Blueprint. It is a step-by-step playbook for the next 18 months covering your counterparty map, your cash position, and the assets most exposed to the promise gap. It includes the counterparty worksheet I described earlier, an asset-by-asset checklist for all 14 on this list, and the 4 quarterly indicators to track so that you are reading the data before the headline is written. The link is in the description and pinned in the top comment. You do not need to be a professional. You need to be early. Remember this. A retirement does not fail from a surprise. It fails from a promise somebody else can no longer keep. And 2027 is the date on the envelope. I am Professor Zhang. Thank you for watching. Now I want to hear from you. Tell me in the comments which of the 14 you are holding. The annuity, the bank certificate, the bond fund, or the entrance fee. And if you have opened this year's annual notice of change, tell me what they took out.